It's gone 6 o'clock, so welcome to our consultation and community engagement on the proposed new methodology for calculating swims charges for 26-27. I apologise, as Tracy coughs as well. I've got obviously a sore throat, a bit congested, so I apologise in advance. I'd like to welcome those people online as well, because we're live streaming this to make sure that we can get out to as many people as possible. Just from a housekeeping perspective, the emergency door is through where we've just come. For those online, we have you muted. If you do have any questions, we'll go through a presentation first. If you can put questions in the chat, excuse me, or after the presentation's finished, we'll also give you an opportunity to put up your hand and provide feedback if you want to speak rather than put it into the chat. I'd like to welcome and acknowledge Mayor Bailey here and Councillor Gordon and Mandy, who are also here.
An apology from Kirsty McGregor, Councillor McGregor.
Thank you. And also acknowledge Tracy, who's just walked out the door, and Clive, who's our Director of Corporate and Financial Services, who will be doing most of the presenting tonight, especially given my voice. Tonight is about information sharing. So we're going through a process and we want to give you as much information as you can. We can give you and answer any questions. If not, we can come back to you with those questions. I want to just be really clear, this is only a proposal and we're seeking feedback. As you may be aware, last year we proposed a depreciation option for the swim systems, which we got feedback from through that consultation on annual business plan and budget that wasn't well received. So we removed that. And we've done some further work and come up with the annuity scheme, which Clive will talk to you through tonight. I want to also be really clear, it's not about council building empires. Council doesn't receive any financial benefit from what is being proposed. All of the money that is involved in the swim schemes, we have 28 of them. They are all allocated to that individual scheme and they are ring fenced, and the money that comes in, all goes out, all comes in and is accounted for in and out of the individual schemes. So if council is building up, which the proposal is, capital reserves to invest in those schemes, then that goes into those individual schemes and is maintained in that for when works happen. So there's with interest, yeah. So there's no benefit from council from doing this other than good corporate governance to make sure that there's money in advance for when capital renewal is needed. So I've touched on that. The other thing is there's no decision to be made. Council is considering this. We last year did this feedback process through our annual business plan and budget process, which is this time we've removed it and we're doing it separately because we want to make sure that we are getting the feedback that or giving the opportunity for those people impacted by it to provide feedback. We're doing it for 5 or 6 weeks rather than 21 days. We're doing 3 of these community meetings. So we're doing one, we've done one in the Arc Bar at the Arc Bar last week in Adelaide, which was well attended. We're doing tonight, which we're live streaming as well. And then we're also doing one in Blanchetown, I think next week, Tracy.
Yeah.
So we're trying to get out, we're trying to get the message, and we're encouraging my wife ringing me. Is my wife ringing you? That's awkward. I had it off. So did I. Yeah, we want to make sure, and the decisions haven't been made and will be based on the feedback is provided. So we really encourage you to do that and we encourage submissions, and we'll talk about how to do that after. This presentation on the slide, on the screens. Council, excuse me, has got 28 swims that we're responsible for the maintenance, renewal and compliance. And as part of that compliance and regulation, we're responsible for the SA Health, the Essential Services Commission of South Australia and the Local Government Act and regulations. And as I said, we're responsible for maintenance, renewal and the compliance requirements. We have an annual service fee, which we've done historically, and this is raised to maintain the systems as only charged for maintenance, renewal and upgrades. In the past, we haven't done a capital renewal component of that, and generally, Clive, we've gone back to the scheme members when we need to do something and spend money. What are you laughing at?
No, we're just laughing at our chairs.
Oh, okay.
Client over here. Sorry, no.
So if, for example, we need investment to do something and there wasn't enough money in the kitty, then we would go back out to the individual scheme members and they would do that at the stage. What we're proposing is to, rather than have those calls on investments, we spread that over a period of time so there's enough money in the pot for when it is required. The annual service fee can only be applied for those individual schemes. So if, say, Kawira's scheme invests money in it, it's not used for Brenda Park. It's used for the individual schemes and only those schemes. Exception to that is Truro and Kawira, where given their new schemes and they were funded through government grants, there was a requirement as part of that funding to do what we're suggesting for all the other schemes. So that's already happening in those individual schemes. As I said, in the previous years, the fee setting didn't include the recovery of all of the internal costs and overcosts, like full cost attribution, which council we went through a process last year, to make sure that all of the costs associated with individual services, just not swims, but waste and other services and programs that we run, that there's an allocation for those costs of internal costs like HR, finance, payroll, etc. And that's important. So the general ratepayer who is not benefiting from a service isn't contributing to the cost of providing that service, and that's called cross-subsidisation, which is not allowed. And we're only able to generate the funds or gather the funds necessary to cover the future renewal of the systems and upgrades of the infrastructure costs. So we're not allowed to charge more than actually the cost of offering the service. So next slide. Is there any questions on that? And if anything I missed, Clive, give my croaky voice. So SCOSA, is the Essential Services Commission of South Australia, and they undertake economic regulation in water, sewerage, electricity, gas, maritime and rail industries, and provides advice to councils as part of the Local Government Act as well. The South Australian Government is a signatory to the National Water Initiative, and that initiative is about addressing current and future challenges in water management moving forward. And SCOSA has made a price determination requiring all small-scale water networks, such as our swim systems, to apply the NWA pricing principles when setting their service fees. And SCOSA's price determination includes 10 principles for recovery of operational expenditure and also 6 principles for the recovery of capital expenditure. Rightly or wrongly, Council used to have a SWIMS committee, and there was representatives from the community on that. And they made the decision at that time that we shouldn't be seeking contributions for capital expenditure in the future. And so that's why the process is where in the past we would have to have a call for additional funding. And so Clive has been talking about this for a number of years because we aren't compliant necessarily with the SCOSA pricing principles by not doing this. And this is why we feel, one, it's a prudent approach, but also we should be doing it from a legislative perspective as well. So any questions on any of that? I think next slide. And I'm going to go pass over to Clive because no one wants to listen to my voice anymore, including me.
As Ben said before, retailers, which is in this situation, the council is required to set water charge to achieve the full cost of recovery. The council should not recover more than the operational, maintenance and administrative costs, any taxes. So we actually do get, and the schemes do get charged EPA levies, and also for provision of the asset consumption. So there's 2 methods that can be used. Yep.
You're not going to be able to see that, but it's all we've got at the moment. So Clive.
Yep. So look, I'll read out the people which are actually in Zoom on the Zoom sessions, they can actually still see the screen. So I'll just backtrack. So retailers which the council is required to set water charge to achieve the full cost recovery. The council shouldn't seek to recover more than the operational, maintenance and administrative costs, any taxes, and also a provision of asset consumption. So this can happen in 2 different ways. So the accountants have a thing called depreciation, which basically is just like an average how much value you're losing in the asset on every year. So just like your your car, if it was going to be 20 years and you're going to lose $20,000 on it, basically it's costing you, you're losing the value of $1,000 each year you own that vehicle. So what we do is with depreciation, that's just the same principle. So if the scheme, so ASCOSA has given guidelines where if the scheme was either wholly financed or partly financed by a council, then you would use the depreciation method. Now, because of the situation where we've got schemes which were either built with the contributions of the shack owners, and then the finished scheme, once it was fully working, was actually then gifted to council. So those assets were gifted to council. In that situation, ASCOSA has said that depreciation isn't the correct method to actually seek some type of capital contribution from people. What should happen should be that there should be an annuity type of a calculation performed. So I'll go further into it and give you an example of that in a couple of slides. So, and if not, I'm sure I can read it and communicate that across. So to meet these principles, the council must be able to reasonably estimate the cost that incurs in providing the services and convert the capital expenditure forecast into a future analysed charge, like I talked about before, which is either depreciation or the annuity. So because of the large amount of schemes which were gifted to council, or in the situation of when we look at Cowira and Truro, retrospectively, they were there was the majority, and then was the value was gifted by the state government, and then there was a connection fee which was payable by each person of that scheme as well. So when you look at it, council hasn't made any material contributions to establish those schemes. But and ASCOSA says in that situation, you should use an annuity type of calculation to work out what the contribution should be from each connection. Okay, so the total CMWS fees for 2025-26 amounted to about $843,000 in total, or about $454 on average. So the figures I'm doing is just an average. I know we've got some smaller connections which have a lot higher, and then we've got ones which are large connections. So historically, they would have been probably a little bit lower than that. So SA Water, if we looked at their water structure of charging out, if SA Water owned these schemes and were operated by the schemes and they used their costings, they would actually be charging $613 per connection. So when you look at the average of 454 versus what SA Water would be, 613, there's obviously a big difference in that. So you could say that, I suppose you come to the conclusion that the people in the schemes, on average, have been paying a lot less than if SA Water were managing it. And in reality, probably SA Water would be not only looking at to recover their costs, historically, they would have been looking at some type of capital contribution as well. For the new financial year, the total operating fees are estimated to be about $1.27 million, or about $683 per connection. So, and then on top of that, we're looking at about $889,000 of capital expenditure for certain schemes. So you can see that there's definitely a shortfall. And once again, I'm talking about overall and talking about averages. And then probably just to give you a bit of a comparison where I suppose it's economy of scales, SA Water on average has about 13,000 connections for each scheme that they operate. And the Mid-Murray Council has an average of 66. So, you could quickly come to the conclusion that if someone's looking after schemes which average 13,000 connections versus another organisation looking after schemes which average 66, probably there's economies of scales. So I don't think anyone would expect that council could run as efficient as SA Water, because they've got a lot larger amount of connections per scheme. So, and there is fixed costs of going to each scheme. So, there's doesn't matter whether there's people with 6 people on the scheme or there's 260. We've got to do maintenance checks and ensure that the equipment's running. Take our regular water samples, which go back to SA Health, to ensure that we're compliant as well.
Keep going.
So I'll go back now talking about the 2 methods. So last year we looked at recovering amount of depreciation and that was based on each scheme and how much value is being lost on their assets or being worn down. And as an example, I suppose if you have a pump which is worth $10,000 over 10 years, its useful life is, or its annual depreciation is $1,000. So it's losing $1,000 each year if you think that life is going to be 10 years and its total purchase price was $10,000. With annuity, works a little bit different. And an annuity also is based on the assumption that the money is received in advance and it accumulates some interest as well, that accumulation. So if we were to have the same scenario where a pump of the future costs us $10,000, what the calculation is what's the value of each year would actually have to place into that, taking in consideration that those funds will accumulate interest as well. So it's just like the example would be, I suppose it might be better to relate to, if I was going to go for a trip in 10 years' time, that's a long time in advance, but if I put $10,000 away in my bank account, I would actually have more than $10,000 at the end of 10 years, because that first year would actually accumulate interest for 9 years going forward. So then what happens with an annuity, we can mathematically do the calculation and say, well, for the goal of $10,000 in the future, what amounts do I actually have to deposit or have in advance? So for an amount of $10,000 in 10 years, you need to only put away $829 each year. And with the amount of interest that accumulates, you would end up with $10,000. Obviously, things change, but what we've got to do is do a calculation of the best amount of interest that we'll think we'll earn from having that money put into the bank. Spoke about that.
With that, you've got to account for inflationary costs for the
As well.
materials and everything that's going up every year anyway.
Yeah, that's right. So what?
$10,000 this year is not worth $10,000 in 10 years.
Exactly. So on our website, we've got a CWMS asset management plan, and on the appendix of that is the forward capital expenditure. And it's all based, so the ones which are currently attached to that document are 2 years old. So when I do my calculations, I've got to say, well, hold on, that was done 2 years ago. So I've got to look at indexing that up to whatever forward year. So if it's in like 3 years' time, it says $100,000. I might have to add 7% onto that to allow for the past inflation plus 1 more year. So with that $10,000, yeah, you're correct. What we do is we do a calculation and we project forward what we think inflation is going to be, and then we do the annuity calculation. So what I've done is I've got on the website now, if you had a look, and you all would have probably went there because you're here tonight, there's a PDF there which has got the next 10 years of capital expenditure for each scheme, and they have been indexed forward. So then when I've got that, I can actually do a calculation for each year.
That'll do it
and
automatically.
say what the contributions are for each one. So I've gone through inflating those costs. So we've got the future dollar values, and then I've done a annuity calculation for each scheme. So I suppose what I've at this stage now have got to, and I'm on the next slide.
Yeah, I've changed.
Have a look at what situation we are as far as our schemes. And once again, I'm just talking about averages. Yeah, there's going to be some older and younger and some other different figures. So on average, the assets that we have in combined for all our CMWF schemes are 58% as new. So they're nearly kind of meeting midlife on average. So some are a little bit further than that. And look, you've got some assets which have pumps, which are required to be replaced every 7 or 10 years. And then you've got some mains, which are, if they're PVC, etc., they have got like a life of 70 to 100 years. So there's a whole lot of variation in there. So in particular, we also have got a number of schemes which require capital upgrade to increase their capacity. So previously, when a lot of these were designed, they were designed with, approximately about 2.5 or 2.47 people per dwelling or per connection. And we probably know that in peak times, there's obviously a higher amount of those. So, we've got that added complexity of great troughs and peaks with our schemes as well. So a lot of schemes have coming forward to council and saying, look, we have got issues and we want to actually look at increased capacity. So council over a long period of time will be doing capacity studies on all the schemes. And I'm probably talking more of the older schemes in the circumstance. It's probably fair to say that because some of those schemes are halfway through their life, some of them have very high capital expenditure in the next few years. I think off the top of my head, Brenda Park has something like over $200,000 each year for the next 3 years. So, and look, they've got some money in their fund, but obviously not that enough to cover that. And for me to do a calculation, obviously, when we talk about, putting your $800 odd away in the future to get $10,000 in the future, well, if you've got around $750,000 in the next 3 years, you can't really do a proper calculation for the annuity because you're just going to come up with this huge amount of figure. So I think what will happen with whatever solution we come to in the end, it's going to be some situations where whatever we increase it by won't be enough. And council will actually have to go to the schemes and say, look, we need like a capital call or a capital contribution over and above the amount that we're charging for your annual service fee. So the CMWS scheme that we had committee previously, their idea was, when we need new don't increase the rate, CMWS rates, keep them as low as possible. These people probably had considerable pressure from the people in the schemes. Were they doing the right thing or not? I'll let you decide. I'm not going to make a judgment. But, I did put forward a number of proposals year after year, but they didn't want to accept that. So we find ourselves in this situation. Some schemes better than others as far as the finance is concerned. So what I've done is I've only really calculated on the requirements for the next 10 years. I haven't taken the next 15 or 25. If I actually included that, the situation would be more dire. It was interesting. I actually had our external auditors here for 2 days earlier, and the principal of the accounting firm came to speak to me, and I had a discussion about this, and it basically went through a discussion like we're doing tonight. And he said, the situation is a complex one, and there's obviously not enough money, and there probably will have to be some type of call. His final comment was, if let's try and progressively improve the financial situation of the CWMS. He acknowledged that it was a difficult situation, especially with some of the schemes.
With the bringing the swims in, has it been a catch-22? Because as they've improved, they've then decided, I'm going to improve the shack. And then do all of those sites have limitations in saying, no, we can't add any more buildings onto this scheme?
Yeah, so there's capacity testing done. Unfortunately, well, not fortunately, they're based on 2.4 people as well, average. So I'm sure you've seen more than 2.4 people in different shacks over the time, especially in peak times.
Yeah.
And they're the capacity of each scheme is based on the number of connections at that time. And so we have a policy that says if anyone wants to join onto a scheme, then they have to make a capital equity contribution, and they have to pay for an engineering assessment to make sure that there's enough capacity for what needs to do to improve or increase the capacity. So yes.
So anyone wanting to join any of the schemes at the moment will have to, on application, provide council with $5,000 so we can do an engineering assessment. So they've got to put money up front, and then from that engineering assessment comes through that whether there's capacity or not, and then if there's not capacity, what additions or modifications need to be done to the scheme, and then the bill's given to them whether they want to proceed or not.
I noticed with the after the flood, a lot of shacks that have had to be rebuilt, a lot bigger than what they originally were. So therefore, they've increased the capacity of the occupants of that property now.
Yeah.
So that's also is going to put their
That's right.
scheme as well.
That was probably happening at a slow, very slow rate. It might have been 1 in 20 shacks might have got redeveloped, improved. Now all of a sudden with the flood, this has obviously triggered.
That's happened in our area. We've got 3 huge ones, haven't we? That have been built.
And who knows, they might have 3 or 4 bathrooms.
Yeah, they have.
Yeah,
they have.
So we've gone old school, and you've got the slide deck in front of you now. So we're on slide 8 at the moment.
Can I ask a question from online?
Sure. Yeah, we can't see you, but yes.
It's okay. I can see most of you there. So my name is Peter Shingfield. I'm on the Progress Association out at Penong and Curnamon, and some of you, we have had meetings with council many times about our system and the finance around it, and the issues that we're having with it's completely kind of at end of life, and it's not handling the capacity at all on peak times. So I think everybody's aware of that. But with respect to the additional capital, I think the association representing the residents out there, we agree that we need to kick some more money into the system. So we're going to be responding back and working with council to try and get a resolution to get more funding in. But we've kind of got a bit of a perfect storm because one, the system needs an upgrade, and there's engineering and planning going on as we speak on this. We've also got 10 additional connections that through subdivision that are in the mix, and we've got an initial report back for those 10, and that will require a significant upgrade to the system. That's in the holding tank, that's in potentially in the pumps, it's in the the distribution, the water above the floodplain, new lines. So it's a fair chunk of the system that needs to be replaced. On top of that, what we would like to try and do is incorporate that upgrade or their inclusion into the system and our upgrade as one project. This is our thinking at this point. So at the moment, we're looking at an annual rate increase for the swims and an additional amount of money per, well, certainly the new connections. So that's a large amount of money for them. And then there's an additional amount of money that we need to calculate to be able to upgrade the remainder of the system. But it would seem in my mind that if we're collecting now some money towards future improvements and capital expenditure, and we are basically renewing the entire system, so I guess the annuity, we would be under the annuity and the calculation of that versus the amount of money that we would need to put in up front is an interesting question in my mind. Is there any kind of thought to how that would work? And, obviously we're happy to work offline with council to calculate that.
I think that's probably the best option because it's very specific to your scheme. So the annuity has been based on the asset management plans that are currently in place for the systems. So any upgrades or increases or changes would change the annuity contribution.
Yeah, so probably what I've made some very simple calculations because, I could do a whole lot more, but it might complex it. The one thing I haven't taken into account, and I suppose if you're going like someone like CWMS, a scheme is going to contribute some money from their funds, or however that's going to come to council. I haven't taken into calculation what the opening balance of the funds are, because if someone has, let's say, a scheme would have $100,000 in their fund at the moment. Obviously, that $100,000 going forward, and as long as they're kind of covering their running costs, and then we kind of calculating future capital, that $100,000 would accumulate some money going forward. But it all depends on how quickly that needs to be drawn on as well. Like if you've got $100,000 and you need to spend $100,000 in capital next year, it'll go straight away. But if you need to spend $100,000 and it's $25,000 over the next 4 years, that will last considerably a long time. Yeah. So the one thing that I'll do as kind of as a second sweep is bring in the opening balances or the current balances of the CWMS schemes to see whether that has any great financial impact. And obviously, if Corner might want to make a contribution, that will just go into the scheme and automatically reflect in their balance. And what council will do will any credit balance in there, we will actually accumulate interest based on our normal deposit rate, which we use with the basically we can get the same rates as Treasury SA, so that would accumulate probably about 4.6% at the moment off the top of my head. So, and obviously if it's in the scheme, so if with council we don't have any taxation, so that you get the full amount. Okay. Good, we're up and running.
We are back.
All right. So probably just to go back, that top line there was when I talked about if you need to get $10,000 in 10 years, you'd only need $829 payments per each year to get to your target, which only you have a contribution of $8,290. If you've only got 6 years, all of a sudden you need to put $1,505 per annum, or 3 years you need to put $320. So you can see that, depending on how far that capital is required, obviously accelerates those rates. And as I said, I think it was Brenda Park had three at $250,000 for each year. Obviously, the calculation is huge, and you just wouldn't be viable to say we're going to give you an annual rate. You'd actually have to ask for a capital contribution. Just on that, so previously the council have asked for a capital contribution because the scheme, they didn't have enough funds in there. There was two options. There was an option that to pay that amount, basically, in 1 year, or council would actually finance that and spread the payments of that one-off contribution over 10 years. So obviously you'd get charged interest, but once again, we use SA Treasury rates, which is very, very low. There's no margin. We don't go through a bank or anything. So that finance would be a lot lower than anyone could get going through to a bank or anything. Okay, so just looking at those six annual payments, that's 82% higher than making 10 payments. The 3 payments would be 159% higher than making 10 payments. So I suppose retrospectively, looking at the annuity method is very, very good when you've got a scheme and you start it when the scheme is early. If you try and contribute, you try and bring it halfway through when you've got this big lot of lumpy. It's like when your car, the first few years you're not expecting very much, and then probably the second half of its life you're expecting a lot more renewals. So when you bring annuity partway through an asset or a scheme, all of a sudden you get these big calculations. Okay, so the next slide here is available on that same page where you booked in tonight, so you can download that. So when I look at that, these are index figures for all the schemes for the next 10 years. So when I look at that, there's 20 schemes which have greater than $100,000 of capital expenditure in the next 10 years, and I've got 6 schemes there which will have greater than $500,000 capital expenditure in the next 10 years. So also down on the very bottom line of that, you'll see other capital. What's happening, and infrastructure couldn't give me the split of that figure, but what's happening also is we're looking at the upgrading of all the remote sensing of the CWMS plant to ensure that we can actually monitor remotely, so we're not spending, a guy's going out and driving for, 45 minutes to turn off a pump and turn it back on. So hopefully the ideal situation will be that we'll be able to see flow rates on each scheme. We'll be able to start up aerators so they override their normal how many hours that they would normally go. We'll be able to increase the dosage of the chlorine. We'll be able to switch on the irrigation so it goes on automatically to try and manage the high flows, such as Easter and all those holiday breaks in advance. Not only that, there's going to be a lot more efficiency, but once again, it'll be an investment that we'll have to put into each one. So, have the ability to monitor, switch on various plants, pumps, aerators, chlorators, and that will have to be recovered as well. Infrastructure hasn't scheduled which sites they'll do. I imagine that it'd be an advantage to do probably the ones which have some type of stress first. Okay. I've kind of talked about this a little bit before. Due to the majority of the schemes being mid-age, several schemes have material capital amounts of capital renewal in the next 10 years. And also in that previous slide, we had all the amounts. There's a number of upgrades for schemes which have issues at the moment as far as the capacity is concerned.
That's what normally happens. We found out there's a 6:15 that IT coordinator didn't know this, but there's a 6:15 turn off to make sure the TVs are off from an energy perspective. So that's what happened. It was automatically, and he didn't know that was in place. So smart. DBs.
Yeah, as I talked about, if we're starting an annuity type of calculation in the middle, halfway through a scheme's life, obviously we're going to have some large calculations when we're trying to work out an annual amount. And as the last up point there, in extreme circumstances, council may have to raise a special contribution against each property, and look, there'd still be the option that someone can't afford it. It would be actually averaged over 10 years, some type of repayment with finance built into it. Since I've been here, I could see an issue that with the CMWS scheme and not wanting to put money aside. So since I've been here, every search which has gone out, which has a CMWS connection, has distinctly said that you may need to have a capital contribution in future years. So I could see that this was happening, but because of the recommendations of the committee, of the CMWS committee, and the adoption of that with council, I could just see a slow train wreck happening. And look, we're here to try and work out a situation. Normally, with a lot of things that we've done, and we've done some quite good things previously with finance, I can't quite see a solution that I can kind of calculate. So, I'll give you kind of some of my thoughts right at the end, but look, we're open to it. A lot of people that went to the ARCBAR session last week, they've looked at the capital renewals. They're kind of like coming back to council and saying, well, can you justify this? Do we need this done on the certain dates? I've been given the figures to model. I haven't been involved personally or directly with the revaluation. That's been done by an external consultant, and I must say that they are very experienced with designing and revaluing a whole lot of CMWSs throughout South Australia. They are one of the consultants which the LJ use when they give seed money to a scheme. So the consultant that did the revaluation and the projections is the same one which was involved with Kawira, the construction of Kawira, and also Truro.
And if we don't spend that money, it stays in the account. So
that's right, accumulates. Yeah. So I always you always and the world's a really strange place. We've had COVID. Now we've got the issues with the Iran conflict. Obviously that sometimes you may plan for things, but because of the supply chain, a lot of them are delayed. So I don't. If we shoot a little bit under, that's fine, and we can always top up by asking for a capital contribution. Yep. So once again, we've looked at and tried to bring forward a bit of a solution. We've said, look, if there's increases, we need to ensure that they're phased in over a number of years. There is some financial strain, and there will always be the option of, if there's capital call, to have a loan to spread those extra contributions out. Overall, if the methodology as put in the fact sheet, if that was introduced, that would give an annual increase of $190 per connection in 2026-27. So, look, it's proposed. We're looking for feedback, and willing to hear suggestions. And we've had a very long public consultation period because we don't want anyone to be short as far as being able to think about this and put a submission forward.
Next one. This one. So, as Clive's mentioned, community consultation concludes on the 1st of June. We're doing these community information sessions that I mentioned previously. Really encourage written submissions because they'll go back into council's a paper that we write for council, so they can consider any feedback. On the website, which is there, there's a feedback form. So you can either do a written submission, you can email it, or you can fill out the feedback form for specific feedback. And as Clive has mentioned, we want to hear what the particular issues are. We don't claim to say this is the best model, this is the only way. We want to hear from the community and those impacted by the proposed methodology on things that you may think we could potentially do differently. So we'll just open to questions. And Tracy, is there any online?
Nothing on.
Any questions in the room?
Why did you choose $250?
That's just arbitrary. Yeah. Like, you know, if feedback comes and says you should cap it at 200 or another figure, like just like you've got to specify something. If I let that blank, everyone would be saying, well, why didn't you put a figure in?
Yeah,
true.
True. But I mean, most of the people I know that are shack owners, I use that term loosely. Most of them are haciendas, are old age pensioners. And when you with the flood, insurance, rebuild. Now they've got all new gear. Anyone who wasn't affected by the flood, $250 each year is going to be hard to find.
Oh yeah, any increase.
It's like the rates keep going that way, and the pension just straight line.
Yeah.
So we're getting into the stage where big for sale signs.
So
well, 90% of the homes are second homes.
True.
Of holiday
Yeah,
homes.
yeah.
90%.
That's what I mean, haciendas.
Yeah. So
because the days of the shack are gone.
yeah.
So many years ago, I'm trying to think about how many. About 15 years ago, council used to get money for people with pensions or on social benefits, and that would actually appear.
Yep.
And we could actually prompt the government to say, "Oh, we've got someone on the pension and they need that amount of money." And now that my understanding, I think the payment's called it's kind of like cost of living or supplementary payment of living or something like that. And it'd be interesting to know that hopefully everyone which has got a CMWS connection are getting that subsidy as well. Yeah. But we no longer, we can't see that information because it's all privacy now. Yeah.
I haven't looked to see whether the, as they call it, COLA, cost of living, is still going.
It is through human services. Yes.
Yeah. So there's supposed to be like a component for general electricity, general rates,
and get off some of your bills.
Yeah. So but I know that there is a distinction because some people just have a septic tank.
Yeah.
And some people are connected to either SA Water or a council one. And unless they say that, they won't be getting that portion of that benefit. It'll be just assumed that they're on a septic tank.
Yeah.
So
age pensioners can also postpone their rates.
Yeah.
So if it is getting difficult, they just pay $500 a year or something like that.
Yeah. The only other criticism I have, and it's just a short one, where you are on your rate notices, where you have CWMS, could you itemise a bit more? All I've got is $1,141. I don't know what the hell it's for.
Yeah. So you're at Kawira?
Yeah.
Yeah. So your portion is, as I said before, just like with the call on capital, there was an option to pay the connection fee up front.
Yep.
One lump.
Yeah.
Or if you didn't want to pay up lump, we actually spread that over 10 years. So I can't remember what year you'd be up to.
They're about year 5, I think.
So... So this year, the CMWS amount is $680. The balance is your connection fee that you're paying off over 10 years.
Right.
Yeah. So legislatively, we can only put one charge on there. Which doesn't make sense to me, but we can only put one charge. We can't say here's your CMWS capital contribution and here's your CMWS maintenance,
Yeah.
it's illegal for us. So we can't even declare that separately. What we have to do is we put the full amount, and then if you ever look at the boring minutes of the adoption, you'll see that it talks about anyone at Kawira that have paid their capital contribution gets a rebate of $400 odd.
Or you can ring the rates officer and
Yeah, that's right.
down for you.
Yeah. So when we do it, and if it's
Local MP.
taken on notice, what we'll do is try and make it clearer. We can. There's nothing wrong. There's nothing stopping us putting it in our new business plan and actually teasing that out into two different amounts. Yeah.
So Kawira and Truro are already contributing to the capital.
Yeah.
Yeah, they have been. Yeah.
So theirs won't go up by 250.
Well, no.
Yours won't, yeah.
And once again,
You're already doing it.
I haven't taken the consideration of their current opening balance. So a lot of people have been asking for the last 5 years of the scheme or what the balances are. And what I've been sending them out. I've got no problems at all with that. What I've just said is a bit of caveat. The balances have been wild swings, and that was because, first of all, when we had the flood, then there was a lot of repairs, and then what's happened was subsequently council has claimed a whole lot of insurance or from the disaster recovery. So first call, what we did was claimed on insurance what we could, and then we did a second pass and try to see what we could actually cover under these. The disaster recovery or the flood disaster recovery. So to give you an instance, electrical cabling underground is not covered by insurance, but we claimed that through the disaster recovery.
Yeah.
So what you'll see is around the flood or soon after the flood, expenses going up high, and that's including all the repairs. And then later on, they will kind of smooth off a little bit, and then what you'll have a bit of a spike, and some will have why was there an extra $30,000 in the following year? And that's when we were getting reimbursements from either insurance or from disaster recovery. And I had to lodge 6 claims. And they've split that up into multiple payments, but I've got the very last claim came through probably about 2 months ago, and I've just got to do an analysis because I need to split back up the amount of money going to CMWS. So I know there's one material one to do with the wastewater treatment plant, but I think the expense was very late in this financial year as well, and that was 22,000. So I have to go through there and distribute that. So each year we put in our annual business plan, the balances of the schemes. But my thoughts, I've been kind of dwelling over it. Maybe we should, I'm going to probably have issues with the SCOs or anything that I do, but because they're saying annuity, but maybe we kind of go back to looking at the amount of depreciation on an annual basis, and then maybe what we might do is say, well, some of these schemes are halfway through, so maybe we could accelerate that amount to twice the amount, and that should be a reasonable amount, but not too much, and that we should be seeking to recover, and then still have those extra calls when the capital comes in. Yeah, that was just a bit of a driving thought that I had previously. So other than that, somehow, I do a calculation and ignore those abnormal amounts and just tag them as they're going to have capital contributions. Yeah.
Just a comment, when people say, oh, do you need to do that? You're not pumping clean water. You're pumping stuff that's got everything in it.
Yeah.
It's very aggressive against pumps and impellers and pipe work and everything.
Yeah.
And that's what they've got to realise. This is not pure water you're dealing with where you can say, pure water, this pump will last you 10 years guaranteed. Sewerage, you may get 2 years, depending on what humans have put into the system. And that's the hard factor into this. So I can see the philosophy behind the whole thing, and I don't have any issues with it. I realise everything's got a life, and it's got to be replaced, and you can have all these pumps in stock now at your depot, but they may never be used, and they'll just wear and tear just from normal environmental issues, and then you can't use them.
Yeah, and I think we've had some really good maintenance people in our CWMS area, and they take advantage of situations. So when we had cranes pulling out all the aerators and all the pumps, they were sending them away to get rewired and looking at the impellers. So we've just been lucky that we've had some electricians which are part of the maintenance crew. So I'm sure that other areas they would have said, "Oh, we'll just buy another one," basically. So, and then it's kind of a fine balance between having schedule something to be replaced, and then saying, "Oh, well, let's," and it's easy for us to say, if I've got a pump and it's on my swimming pool or something, and say, well, I'm just going to wait for it. It's making noises. I'm just going to wait till it blows up, basically, or knocks the fuse out, and then I'll go and quickly buy one. But when you're dealing with sewage, if we have a leak or an issue, it's instantaneously an issue with everyone there. And if we have any leaks, every leak now, we've got to actually contact the EPA. So, and they were here earlier this week, saying what things have got in place to ensure that you don't have leaks. And I think we've probably got a bit more of a focus in that a lot of our schemes are right next to the Murray River as well. So,
And if something breaks down, the ratepayer is on the phone straight away. It's not working. I want it working now.
Yeah, that's right. And if the holding tank overflows, it's very close to the river. Yeah.
And Clive mentioned that we're looking to get some wireless technology. For example, over Easter, we had staff doing call-outs like constantly. And obviously there's costs associated with that with overtime. And so if we can do things remotely, then that will reduce the costs. And obviously the costs we can reduce to the individual schemes as well. So we're trying to come up with efficiencies to make us more, we work smarter than we have been in the past as well.
Well, it's all the technology, improvements in the technology. You've got to use it. Otherwise, you're just going to be left behind in last century.
Yeah.
We represent Caloot Landing. We set up, our system there around about 1990, somewhere around there.
2000.
Was it 2000? Well, yeah. 44 shacks at a cost of $220,000. I'm assuming the tanks, and I do understand the, financial issues that the council is dealing with, but we set up our system, 44 shacks, 220,000. And I can't see why we would need to replace that whole system. You got 100 mils sewer pipe, PVC pipe. Can't see that that's going to need replacing. I'm assuming the tanks are concrete. Some of them I can't see because they're in the ground, but I can understand that you might replace a few pumps and things. But I just find it hard to believe that we would need to replace the whole system.
So probably those figures which I had there, I can give you a detailed list of asset per location, and you can have a look at those. Yeah.
Yeah, seeing we set it up anyway privately, would you like us to get an independent quote to what your people have come up with? It just sounds extremely excessive.
Yeah.
Just to jump in there, Aaron Webb's my name, and involved at Caloot as well with Keith. We did get that through one of the other Caloot residents, that 20-year breakdown of the proposed costs, and without going into too much specific stuff, because we're just Caloot and there are 20 other sites. But just because it will be relevant to other people also, in that projection, it's proposed to replace 2 tanks in the next 10 years, one in 4 years' time and one in 7 years' time. at a cost of $315,000 each per tank, which sounds like an awful lot of money for a tank.
Ridiculous, yeah.
So there's specific questions, and that's the main. And the Kalute costs over 10 years projected $1,071,000 of 600 and something is those 2 tanks, and then there's pumps and other things along the way. Have some specifics. So that's obviously what's the story with those tanks? Do they need to be replaced? Obviously they're 25 years old now. Did the engineers look at it and say, well, they've got a 30-year lifespan, therefore we can replace them after 30 years, regardless of whether it's in good condition or not. So we did have some specific questions which then would affect everyone. Does council propose to, obviously you've got to maintain these systems and allow for renewal, with these engineers' reports that they've developed, do you propose to follow that and therefore to say, well, okay, in year 4 from now, the engineers said we should replace that tank. Therefore, regardless of whether it's still working fine or not, you want to go and spend $315,000 on that tank. Is that the proposal? Is that how the council plans to tackle it, to follow this?
That's why we have asset management plans, and if you feel like there's questions that need to raise, you can raise them through the consultation, and we'll pass them on to the independent consultant.
Well, I suppose the concept is though more about, and I understand that you can't just wait for everything to break. Wait for something to break and then I'll quickly go to rush there and fix it because no one's then got sued. I understand that.
You might monitor the.
But do you plan to do the asset management people intend to follow this plan? That's my question.
That's why we have the plan. If the plan's not right, then we need to challenge that.
So they would replace it even though it may not need it.
So that the engineering assessment has said that the life of the tank is X. And so that's what the plan is.
Yeah. So whether a condition rating check needs to be done on that. So I suppose if I take it and look at another class of asset, say roads, we'll get complaints of a certain road, and we'll look at our asset management plan and say, oh God, well that's not really due for another 4 or 5 years, but then they might do a site and say, oh my God, yeah, look, it's gone. And then we may have a road and it's due for replacement next year, and you say, well, it's stood up for whatever reason, it's good.
A road is somewhat different to, for example, a concrete tank or something. Depending on the wear and tear on the road, the weather, a concrete tank is not affected by those things. So it could, a concrete, I've got concrete tanks that are 100 years old.
Yeah.
It's still fine.
And I'll take your point. It's obviously based on the assessment of it, and if it needs to be challenged.
It's a very big, for that area.
We have to put a process in place because we've got 28 schemes. And so we can't do individual condition assessments on every single item. So
they haven't been assessed. So that's a good point you raised. So this hasn't been developed based. This has just been like the engineers looked at it and said, well, this is the system. These are the physical assets that are there.
Without physically looking at it.
Without doing an inspection.
I think my understanding, I didn't check.
They would have done some samples, but they wouldn't have gone to every scheme and looked at every cement.
Yeah, I understand.
Yeah.
Because that wouldn't be
because in a group where there's only 44 shacks or sites, that's a significant cost, and I understand there's sort of pretty much no money in the kitty for the Kalute scheme, as would be the case with most of them, I imagine. But this is proposed. There's $400,000 to be spent in the next 3 or 4 years, according to this, which is a lot of money for people who.
So you'll
raise a special levy. Because the $700 a year is not going to do it.
No. So we encourage feedback, and if there's specific things that come up like that, then raise it. And we might have to look at increasing that sample, because that's what they would have done. They wouldn't have checked every single tank across 28 schemes.
So if we got an independent assessment, would you look at that, or you wouldn't take no notice, or?
I would consider it. Yeah.
Your independent assessment might cost you 10 grand on its own. Consultants don't start in less than 10 grand.
Well, I absolutely don't agree with that assessment.
So whether council's making an investment with the CWMS or you would expect some due diligence, especially when you get to the 6 figures. Yeah, definitely.
Yeah.
And we would obviously like for the ratepayers involved in that area, when there is something significant cost of that, for obviously the association or the representatives to have some say, to have some involvement rather than just we don't hear anything about it and then suddenly everyone gets a bill for $8,000 or $10,000 or something. Well, there should be some input from the association.
We get input from the individual
prior to significant capital expenditure.
But there's another aspect to this as well. We've got public toilets down there, so now we're going to and that when we put in that septic system, back in whenever it was 2000, and then the council took it over. So now we're going to fund all the public as well.
Make a contribution to public toilets. As part of
it doesn't look like it on those figures.
Yeah. So what we've done is gone through and
So the council just connected up to our system.
Yeah.
And now, surely,
and at the peak times,
we're paying for the whole lot.
At the peak times, the public toilets will be using heaps.
Yes.
Yeah. And there's probably, I think it's probably under.
So Blanchetown, Bolto, Caloot, Cornamont, Greenways Landing, Loxton Walker's Flat and Swan Reach all have public toilets connected to them. Yep.
Yeah.
Yep. So if there's a capital contribution required, like council would have to make a capital contribution based on like a connection equivalent.
Yeah.
What percentage would you work on, do you think?
Well,
One connection.
yeah. So when they were doing some capacity work, one of the maintenance supervisors were asked to give his opinion based on like the number of people that they see in each one or candidates. Right. Yeah. So I haven't got those figures in front of me, but and he took into account that people were actually just going to the toilets, so they're not washing their clothes, they're not showering or using like a dishwasher, etc. So and I'm not sure, I think he actually had a talk with the consultant and they came up. So I haven't got those figures there, but I know there was some work done on that because they were looking at especially looking forward in the capacity of each scheme. Yeah. They actually had to bring that public toilet into consideration.
From what I've seen, there's like when you've got a busy weekend there with the public, it seems to be a major expense to come and to unblock the system and
definitely.
Yeah, we understand that.
It's not just like counting one connection. It's it's a reasonable expense.
Yeah, and the general
going to like the issue with the public toilets will be charged the public toilets, not Caloot CWMS. Yeah.
The general consensus at Caloot amongst the shack owners is they prefer the public toilets to be removed.
Well, they're all
gone because, and we understand from the maintenance fellow that's there often that a lot of what he does is fixing the stuff that the public people, the problems that they cause.
Provide services to the community and community can use those services.
There's no one in the actual community wants the toilets anyway, and I know it's a massive expense for the council, and then looking at another probably $160,000 upgrade to the toilets, costs them $40,000 a year to maintain. You need to make it wheelchair access when you do upgrade it. And we're all for don't do it. Just get rid of them.
Yeah. That's not just an issue for you. You go to any council anywhere in Australia, there's public toilets that are hooked on the councils are paying for, and it gets into the mix. Now, unless you go into the deep figures that councils produce, this is just a brief, really. I'm not a councillor, but I've been with councillors for 25.
We've been there, done that. We're not doing it again.
Well, so on your point, if
on our behalf,
we get more accurate data, then that's what we want. Because we don't want to be having people invest in things that don't need to happen. And so, we can consider, as long as it's a reputable and we're comfortable with the data and the consultant who's doing it. If it's going to improve accuracy, then I can't see why we wouldn't.
I mean, the public toilets were great when we didn't have that system way back when. But then when we did have our own system, they really weren't necessary. And I know, council, from what I gather, would prefer the public come to the places they've set up for the public, you know, like here in Manham, Murray Bridge, you know.
It's a public area,
Yeah,
so public can go there.
yes,
If they go there, then they need services.
But a lot of the places equivalent to that don't have those services.
Yeah.
Just that there was some public toilets put in there in the 70s, you know, and then because there wasn't a common effluent scheme, and now there is, and every shack is obliged to be connected to it. So
we're just trying to save money.
yeah, and we understand it's a significant cost, and you know we read your newsletters all the time and say we'd like to save money. Well,
we prefer you to be on SA Water.
So sorry, I missed that.
We prefer you to be on SA Water because then we wouldn't be having this conversation.
No, I understand.
And you're getting charged more as well.
Yes, but we wouldn't be paying for the infrastructure over time. Like if we paid $600 a year, that's all they're paying, and that maintains the infrastructure. But they've got multiple. I understand the volume.
You know, this whole thing with the swim schemes it hasn't been dictated by councils, it's been dictated by the state government and environment policies that are beyond council. It says, you want to have this here close to the River Murray, you've got to have this now. And, you know,
I'm mindful of time, Peter, and I'm mindful of Peter and I think Tim online. I'm not sure if you've got any questions or comments that you would like to make.
So just to clarify then, for what's being proposed is that, so we understand all the numbers, and thank you, Clive, particularly for explaining all that. We get all that, and imagine most people do. So are you proposing basically that obviously these fees, the annual fees have to go up? You want to cap them at the increase at $250 a year, which obviously has got some logic to it and sense to try to protect people. But are you planning to are you looking to lock that in for those $250 a year increases for 5 years, so 10 years, or?
So, you know, because it's annuity, and then, you know, the asset management plan may alter, you know, who knows, they may do some more condition ratings, whatever. And then, you know, and there will be some which might spend, you know, $250,000 and we might have a call. So then you do the calculation and then you look at the next 10 years.
Right.
So, you know, like, because it's no good, especially if you've got one scheme and let's say they're lumpy and they've got the capital just required at the first 3 years and they've got nothing left in the 10 years, and let's say, or very minor stuff, and even over the horizon year 11, 12 and 13, once they get past those, they might be able to reduce or just keep it at the certain rate. Yeah. So
if we didn't need to replace that whole system, you know, that if you don't need to spend that money, then that would be reduced.
Yeah, you do a recalculation. Okay, that's right. Yeah,
you do one every year.
Yeah, that's right, because you kind of like you possibly may have done some capital and it may have been material. So then you look at the next 10 years and say, oh, what's the requirement now?
Yeah.
You know, like, and hopefully, you know, maybe in 5 or 7 years, you might say, hey, you know, like the annuity's been working, and council may be able to look at the next 15 years.
Yes.
And once again, then that averages it out a lot more.
You understand? Yeah.
Yeah.
So our tanks that were supposed to fall apart or whatever in a certain date, they go, oh no, get someone to look at them. They go, oh no, they're going to last another 50 years. Then we go,
that's right.
Yeah. Okay. So
and
that's fair.
it's all to do with the conditions.
Yeah,
I've been at Hawker Council and we actually had to redo all our stormwater because high salinity got in with all the stormwater and just fretted everything out. So I've seen the extremes. I imagine that, you know, because you're using river water, low salinity, you know, everything that goes through our body, there's a little bit higher salinity when it comes out, but not, you know, it's pretty good. You know, like there'd be a lot of places which would use bore water, and so their assets would, you know, all the cement tanks and that would survive. It'd be shorter lifespan. So, yeah, so you've kind of got, I think you've got reasonably good environmental with the assets, yeah.
So just to clarify, sorry.
Sorry. So I'm just mindful of Peter and Tim online, and I'm mindful that people may want to leave. So happy to continue the conversation, but if you do want to leave, thank you. Peter or Tim online?
Yeah, look, I think I'll wrap it up. For us, for Kernamon, I think we need to come back with a written submission and try to meet and work through some of the nuances of the additional connections and the upgrade and the additional fees and, any additional funds that need to be put in and how that would be calculated, because it's kind of a bit of a complicated thing to try and pull all of those threads together. But from our perspective, we're kind of really looking forward to getting the system upgraded and future-proofed. And, I think the issues that we're having, particularly at peak times, is, just at Easter time had my pump burn out. So I had one of those call-outs. I had a sewer flowing into my bathroom. So the sooner we get it fixed, the better. So we're happy to work with council to come up with a practical, cost-effective way of managing this for the Curnamont swims.
Thank you, Peter. Is Tim on?
Tim.
Yeah, hi, thank you. Nothing at this stage.
All right, thank you. Well, we might end the session there and don't feel like you have to leave. We can continue the conversation, but thank you and apologies for the technological issues. Even though those online didn't have any, we had some in the room. So thank you to Tim and Peter.